Hello traders, it's Samurai Trader here. Welcome to this training session, how to scalp and day trade your way to financial freedom, trading divergence. We've got a lot to cover in this session. I hope to try to keep it to 30 minutes. We'll see how we go. First of all, there is a risk in trading. Don't trade with the rent money. What I recommend is you pause the recording and read the disclaimer. Very important, traders, of course, that you master the art of trading before you start in simulation, before you start trading real money. As always, my videos are raw, real and unedited, so if there's any blips on the way, you'll have to forgive me. Just a very quick advertisement. Please make sure you subscribe to my YouTube channel where you'll be able to be kept up to date with all of my videos. Better still, visit my website, imadaytrader.com. become a member. For $197 you receive over 15 of my day trading, swing trading strategies. There are hundreds of videos now, free indicators, cheat sheets, manuals. It's the most comprehensive program in the world. I'm serious. Go to my website and see for yourself, and of course don't forget to request my free training manual. So click on the link below. Traders, that's the end. Add over. Let's move on. Okay, excuse me. So trading's nothing more than a pattern solving exercise. The market has a memory. We see the same patterns in every market day in, day out, and so it makes trading a lot easier. And trading is not rocket science. It's about patience and pattern recognition. Yet at the same time, we have a certain number of challenges with trading divergence. First of all, I love the saying, the person who chases two rabbits catches none. That is, when you're attempting to trade a divergence trade, quite often if that trade fails, you miss out on a really good with trend trade. So that's one of the challenges with that. And unfortunately for traders, traders continually are trying to pick tops and bottoms. Now I'm going to be showing you and giving you some real techniques today on how to pick tops and bottoms. However, what I highly recommend, until you master the art of trading with the trend, you stick with trend trading initially. Okay, master that, then you can add divergence trading. Now at the same time, I love divergence trading, and you'll see why in a few moments. Now in training members, what you got to really do is really learn how to pick a trend, then how to pick a change in trend. Okay, so there's a number of classic patterns we see, like the ABC. Some of these won't mean anything to non-members, but I'm going to show you in a moment a lot of patterns. So some of these are not going to be relevant to you, but what is relevant is the type of counter trend trading strategies. You've got, first of all, pivot bounces, which I'll show you. Pivot bounces are fantastic. That is floor pivots. Virtually every trading platform now, you've got floor pivots as a standard indicator. When you get a pivot bounce along with divergence, that's what we call a loaded trade. Then we've got the snapback. The snapback's rather unique. That can be a major move due to news. Now with some of those major moves that we have, where we get a reversion to the mean, where it snaps back in the opposite direction, if it's news-based purely, sometimes they move that quickly, you don't have the opportunity to actually trade them. Other times you can, but I'll show you what I mean on the charts very soon. Double tops, double bottoms. We just had a great one on ES. Actually, let me just show you this, and let's just go to the chart now. Just make sure I've got the right one. Comes up, there we go. If we go and look at the ES right now, so I'm recording this during the Globex session. So the market here down below, we can see here it's now just make sure I've got my timing right. Yes, okay, so right there we had a beautiful double top. So this is during the Globex session. So the market opened around 20 minutes ago back here on the, so this is 5 p.m. Central Standard Time. So we have the market opened, we've rallied up. This is the ES Renko. This is a 4-tick brick. Okay, so we've got a 4-tick brick, $50 per brick, and you can see here we had our classic double top. Now what made this so good, and let me just move this over for you, this is what you would have been looking at the time okay, is you can see we also had divergence and you had extended divergence here. So you had divergence on your anchor chart and you had divergence on what we call our entry chart. Now I should just point out, I love trading with three charts. I've got what we call my entry chart, I then have my anchor chart 1, and I've got anchor chart 2. Now for newer traders, you can actually quite comfortably get away with just having two charts. Okay, so you've got to always got that higher time frame. Why? Trading with the trend, we want to be trading in the direction of the higher time frame. But let's get back to this. So double tops, double bottoms, very easy to recognize, and we'll go through a few rules with those in a moment. Then we've got the classic T19. Now a T19 is a code. You may notice we code all of our setups, but a T19 is just where you've got standard divergence on your entry chart, and that's also your lowest probability divergence. When you've got divergence such as a 1D, 2D, or a 3D, that's where you've got divergence on your higher time frames. Much more powerful signal. Now Larry Connors has said this, that philosophically I live in a world of reversion to the mean when it comes to trading. What that simply means is something stretched too far will snap back, and that's where we come to the T3, and I'll show you some of these classic moves in a moment on the charts. So if we look at what makes up divergence, now we're going to talk about standard divergence today rather than hidden divergence. I've never really been a big hidden divergence student or fan. I love standard divergence. So if we look at this price action here, we can see down here that I've got a lower low on price, and on my divergence indicator I've got a higher low, lower low on price and a higher low on my oscillator. To go short, I've got a higher high on price and a lower high on my oscillator. Now if we're trading and talking double tops, we would have a double bottom or a double top, with the same thing happening with our oscillator. The market loves to try things twice. Okay, quite often, many times, if it pushes down twice, it fails, it will rebound. Now if we look at, there's a gentleman actually wrote a book, it was called Trader Vic, Methods of a Wall Street Master. He wrote his book back in 1991, so what's that, about 29 years ago now, and he became quite famous with this setup, and this is on a time-based chart with his 2B buys, and he's also got what we call his 2B sells. So the name of the book is Methods of a Wall Street Master, and also Suri Dedala, who's quite famous for his trade patterns like the pros. In his book he covers this quite extensively as well. And the difference here is, going back 29 years ago, of course computers weren't used like they are now, so we're talking about exactly the same thing, except we want to see an oscillator working in our favor as well. So here we've got a higher high on price, and we'd like to see a lower high on our oscillator. Likewise, if we were going long, we've got a lower low on price and we would have a higher low on our oscillator, and we're looking at an entry here as well, and I'll show you how we do that on our charts in a moment. So let's go through some basic rules that are absolutely what I call non-negotiable when it comes to trading divergence. First of all, do I have divergence on a MACD? You can use a number of different oscillators for it. You've got the MACD, you can use a CCI, you might use with CCI an 8 period to up to a 14 period. I've got a custom MACD that I use, and you can actually adapt a normal MACD to virtually model it exactly, but because I like trading very short-term divergence, mine's very tight. Okay, but you can use a MACD, a CCI set to a period of 8 to 14 works really well. You can use an RSI, Valerie Williams %R works brilliantly as well. So there's a number of oscillators indicators you can use to help you there. Now of course you can also be a pure price action trader and just trade purely off the pattern, but what is very important is this: do I have angulation? So what exactly is angulation? Well, let me just show you on this chart here. This is angulation. Here are my EMAs, okay, and you can see here how price is angling away, and this is actually a live trade I took where I shorted on the NQ5 contract. So you can see our price is angling away. The steeper the angle, the better it is. Very, very important you have angulation. What you've got to be careful of, traders, even though we don't have a divergence trade here, we see this a lot where it looks like divergence. Notice how price action is fairly much running parallel in a tight channel with my gold EMA, my 34. Notice how it's running very much in parallel here. That's the channel. This is where divergence traders get killed. Now this is what's really important to me. From my entry, and when I trade divergence trade, I want to enter on the close of the third candle or brick. We will look at some tick charts. This is Renko, so you can once again you can trade with time-based charts, Renko, volume, range. It really doesn't matter. It just comes down to personal preferences. But what is important, that I have a confirmation of the trade. Okay, so that's why I wait for, or I wait to close below my blue trigger line if I'm looking at tick charts, which we will look at. So what's important, from the close of a third candle to my yellow EMA, we call it follow the gold. Is there enough distance there for me to make a profit? If there's not, I will give the trade a miss, unless I have divergence on higher time frames as well. So there, that qualifies. Now this one up here I ended up taking as a live trade. Now it's maybe a little bit hard for you to see, but I had divergence there on my anchor chart, and it was also what we call a 200 EMA overshoot. This makes it a very, very high probability trade. Okay, so that was 16 ticks, $400 less commissions. Okay, but that's angulation, where price angles away from your EMAs. Now you can use standard moving averages, but what's important is we get that angulation. Now also, do I have a double top or double bottom? That's important. Or do I have a higher high on price or a lower low on the chart? So on the chart with price action, do I have a higher high? And I like to see what I call a V. And what I mean by a V, price rallies up, comes back down, and rallies back up again. I tend to find the very best divergence trades are when you've got that V setting up. Okay, it's like the market pushes up, people profit taking, we get what we call it a 2B, just there, a nice trade, rallies up, and away we go. The next one is, where are the EMAs? Where will price bounce? And that is also very important to us, because this one right here just there is actually, oh no, you could still classify that. You got a little bit of divergence there and you got divergence there, so that is actually a 2D. Just there, it comes down and we get a bounce. If you've got just very low probability divergence, you'll usually bounce on the gold. Okay, so on our yellow EMA, follow the gold will usually bounce, and you can actually see there you had a little bit of a bounce. That's profit taking. When you've got a double divergence or divergence on higher time frames, you'll usually come down to our 89, and we'll usually, so these are what we call price magnets. So let's look at some examples. So what we've got there is our classic double divergence, where you've got divergence on a couple of different charts. Now what is important is the formula. So we've got a formula that we use to set up our entry chart and our anchor charts. So we then go to here. Now I've got a tick chart. Now this is a tick, and I've got the tick chart right next to a Renko. So we love Renko charts, but at the same time I always have a relevant time-based chart or a tick chart that's sort of relevant to the speed or thereabouts of the Renko. Why? Quite often you'll get because with Renko, they're beautiful for smoothing out price action. Okay, they're great for that, but you can also lose some valuable information such as divergence. Now you actually had it started to set up, but it's not so obvious there. Now it is very obvious here. Now here also we had what we call a slingshot trade entry just there, so you can see our slingshot just there, which is nice. And the only obvious sign over here was the tail on the Renko. And yes, traders, tails are very tradable as long as they're not too far into the trend on Renko charts. So what we like to do is look at both Renko and tick charts. So this here was our classic T19. Okay, and always we want to know what's the distance from my entry to the 34. Next one here we'll look at here is what we call a T3. Now a T3 is one of these mean reversions trades where you get this big move like this. Now we always like to look at the tick chart. In this particular case, this is on the ES. We had what we call a great bubble. Now when we explore this trade, see the angulation trade, see that, see how price is angling away. You've got that big angle away. You basically got a wedge being driven in the price, then it snaps back. These are a very high probability trade, even more so when you bounce on a floor pivot. Now that's a midline pivot, which is just as good, but we went straight through it. So if you've got a pivot bounce and a T3 or a standard divergence trade, you've got a much higher probability trade coming off. Now we look at this one down here. I've got a classic 2D. You can see here I've got a lower low. There's my V. I've got a lower low on price. We're not going to discuss all the other trades we had here, but there is my divergence. And look over at your anchor chart. Lo and behold, I've got a pivot bounce. So I've got a pivot bounce, divergence. This is what we call a loaded trade. Okay, they're very whoops, sorry about that, high probability. Where are we? Yep, so you've got a pivot bounce, you just can't quite see it there, and that's where you've got to be very cautious. So if you had entered a trade here, you always want to know where your pivots are. Okay, so what I've got here on this particular chart is a double top. So we won't worry about the other trades here, but right there we can see we've got a double top, and see how we've got a slight height difference. Look, it doesn't matter if you're out within a couple of ticks. Looks like a duck, walks like a duck, it's a duck. Okay, so there you can see we're out by a couple of ticks. So that's sort of a great double top. And what makes this even better, it's in the direction of the trend. And actually we call these bet the farm trades. Okay, because when you got a double top with divergence, and we actually had double divergence in the direction of the trade, they're a really loaded trade. Now down here we've got on the midline pivot, we've got a great double bottom again. Okay, so there we had a double bottom with divergence. Over here we had a lower low with divergence. Now the highest probability divergence trades will be when you're bouncing off the pivot. So you did have a 2D there and it delivered nicely, but your highest probability on the pivots. Now if you're trading oil or black gold, I recommend you always want to be trading either a round number or off a pivot. Now if you're on the NQ, the ES, they're not too bad for trading if you're not at the pivot, where you're not getting a pivot bounce as well, but definitely on oil you really want to wait for those pivots. This is actually on oil itself. So here I've got a lovely double top, and I didn't take that for some reason, but I took this T10, which is off the double top. Okay, and that was still a nice little 8 tick trade. Thank you very much off that. So you T10 after you get these double tops, and look at this on my anchor chart. See that there? So I've got beautiful divergence. What you tend to find in our targets, we actually target the cyan. So when you've got a double top with double divergence, you get you know a very high percentage, about 90% of the time you'll come down and hit the cyan EMA. Now we nearly always get a bounce off the gold, nearly always. That's profit taking, and this is where you've got to learn. Even if you're a trend trader, you still want to clearly understand divergence trading, because you want to know when to stop taking trend trades. Where we want to be extremely cautious of taking a trend trade is if you're off double divergence 2Ds, as nearly every time we'll get a bounce on the 34, but then we retrace. Okay, and that's actually, we call that a ka-ching trade or a T10. Okay, and look at your long-term stochastic coming down there at that stage. Let's look at another example. We're looking at the tick chart. Now this is on the black gold, on the Texas tea, the crude oil, during the Globex session. This is an 89 tick during the main trading session. Excuse me. I like to trade the 233 tick after hours, the Globex session, where you've still got some great trading opportunities, and it's great if you get home from work, you want to trade after hours. If most of my I've got over 8,000 members now, most are US based or Europe. You get home from work, you've got the after hours market, you've still got on oil, ES, some great trading opportunities, and even with the 10-year note if you're very patient. And we'll have a look at the 10-year note in a moment too, because we just had a beautiful double top. And look, traders, they say that yes, you can look back at something afterwards and say, well, that was easy to pick, but they're also very easy to pick from the right hand side of a screen if you know what you're looking for. So we've got a high on price. That's a nice little short that I took. And now the thing there is to consider adding. If you're trading, the maximum you want to risk is 2% of your account. So say if you're only trading 1%, you get a double top like this. Can you add to the position? Absolutely. Okay, this is another one here, another short. Now this was just a T19, just a standard divergence trade, a nice little trade there of 7 ticks. This is on the ES 2 tick Renko. There's my little V, my high on price, and there is my divergence. Thank you very much. 437 less about $20 in commissions. But so what are we looking at now? Down here, see this here, traders, you've got an overshoot. This is a T3. See the angle on my anchor chart, and see this here, see that wedge formation that's been driven there. You also had a T3 there as well. Okay, now here, this is just a nice T3 and a pullback. When you have a T3, always expect a 34B straight after, always. Okay, look, if it's an extremely high, I might, but I'm always expecting to bounce on it. Just a very high proportion of them will, until I start to get divergence on a high time frame. When I get divergence on a high time frame, I'm expecting to pull back to the cyan. Here we've got another great example of a 2D. We've got a high on price, divergence, thank you very much, and a pullback to the cyan. And this is where, when you get 2Ds, very steep divergence, your bounces thereafter become a lower probability trade. We've got here, this is just a little scalp. Now this was a loaded trade here, and this is on the ES. Now it may not look much there, but that was actually 6 ticks on 10 contracts there. Okay, so what I had there was a couple of things. First of all, on my highest time frame, these you take every day. These are just a brilliant strategy of trading the EMA bounces on your higher time frame after we get what our super scalper plots. So see my divergence, so just imagine you were on the right hand side of the screen and you couldn't see anymore. What you would see is a lower high, a higher high, major EMA bounce, the white candle, the super scalper plots on the third candle. Thank you very much. It's a no-brainer trade. Now we come here, we come on down. This is what we call a floor pivot overshoot. So just here we ended up having some divergence, and just there, so we had divergence on the anchor chart, and that delivered nicely. I didn't trade that one. I took this one here. This one, it was actually a 2D. It's mislabeled. There is my divergence, and look over at the higher time frame. Thank you very much. Now we look at the tick charts again. Now what you've got to be very cautious of with divergence trades is, see above, I also had a floor pivot just above there. You have to be very careful because floor pivots are what we call magnets. Sometimes you'll have a divergence trade set up just below the pivot. It all looks great, got everything looks fantastic on the setup, but you take it and immediately it bounces up to the pivot like this one here. Now that actually followed through because what actually happens is floor pivots are magnets and price gets attracted, so you want to be very careful. So there you actually had a standard T19. Then down here we then had a 2D. What makes it a 2D? High and price, divergence, and thank you very much. Then it turned into a pivot magnet trade and we rallied up. So be very careful with divergence trades when you're very close. Now what we've got here is we rallied up and we've got a T3. We've got no divergence, but look at that angulation. See that, how price angles away, and what are we bouncing off? We're bouncing off the floor pivot. So we can see here, this is our midline pivot bounce. What was once resistance becomes support. So you can see we've got lots of support. We come on down, and that right there is also what we call a pivot magnet trade. That's where you sell into the pivot. Now with oil, you'll notice traders that on the 20 cent, 50 cent and round numbers at 74, 75, you'll see I always have and drop in a horizontal line. These are also very strong support resistance levels on oil, very unique to oil. So when that comes up, that looks great. What I like to do is always look at the tick charts. So this is the relevant tick chart. Now this is what we call a bubble, and here is a little secret on trading divergence, particularly these severe moves on tick charts. Note how price action has moved away. See that there, it's gapped away from the trigger line. See that? And see over here on my anchor chart, see how price action has gapped away. This is a pure mean reversion trade. When you see that, sell the farm. Okay, you want to put the lead on it, bet the farm on it. Okay, these are, I'm only joking, you never ever go beyond your normal risk management rules, but there is a great, we call them bubbles because they burst, all right, and it comes down. But you see these patterns. These are all patterns that we see every day. And the last one here is, this is another example here of a T3. This is looking at your Renko. Now on the Renko, you can see here we had virtually no other re-entries there. Now quite often, probably 50% of the time, these are not tradable anyway. They move quickly, but the other half of the time they're very tradable. And this is why we look at our tick charts, is we've got slingshot trades on the way up. So where we might have missed out on any re-entries on a Renko, we had some nice with trend trades on the way up. Now we get up here, and this is a definite mean reversion trade. Look at the angle of price action from the EMAs. See that there? So what we look at, traders, is this, is we want to close below our trigger line, which is our blue line. Okay, that is our trigger to close below the trigger line right there for a very nice trade. So traders, when it comes to divergence trading, there are some fantastic opportunities. But look, what I say to all traders is really the secret to mastering the art of day trading and scalping is really this, and I call it Curly's law. And I know many of you and existing members, if there are any existing members watching this, and any members that have seen my videos before, I talk about Curly all the time. So Curly, you may remember, is that Jack Valance, a great late Jack Valance, out of a movie, City Slickers. They're riding back, and Mitch, who was Billy Crystal, said, Curly said, you know what the secret of life is? He holds his one finger up. Mitch says, Billy Crystal says, your finger. Curly says, one thing, just one thing. You stick with that and the rest don't mean shit. But what's that one thing? And Curly smiles and said, That's what you've got to find out when it comes to mastering the art of day trading. It comes down to focusing on only one or two strategies initially, and you build from there. You start with your trend trading. Now, very quickly, I just wanted to show you, and I did mention here, so make sure you become a member, traders. I mentioned there was the double top on oil, sorry, on the ES, but also then on the 10-year note. So if we look at the 10-year note here, we can see here we had a beautiful double top. So this is 5 p.m. Central Standard Time. That's when the market reopens. So reopens here. One of the huge advantages we've got in trading the 10-year note, the broken margins are only very low because it's relatively low volatility when it comes to the note. You're looking at 1563, I think it is 1562, 63 per tick, which is what one of these green, that's per tick there. This is a 1 tick Renko, and you can see here how price rallied up to the floor pivot there, and then I formed a little double top, and my entry is actually the close of the third candle, and I've already got this underway, so I'm not on this trade here. Now down here, 1 2 3 4, just say 5 ticks. Let's just be conservative. 5 ticks is, and that's been down 7 or 8 ticks. Now 5 ticks is $78 on this market, and you know, it's just a really reliable trade there. Now that trade there, now there's our classic 34B. It was 2 minutes after the market opens. I usually like to give the market about 5 minutes before we fire off any trades. But what makes this a no-brainer? Look over at your anchor chart. What have we got? We've got a higher high on price. I've got a lower high on my MACD, and I've got a pivot bounce, a double top on my lowest time frame, and a pivot bounce. Traders, that is a no-brainer divergence trade. These are, you know, you could trade these all day and you'd be happy the rest of your life just looking for these patterns. Now why don't we just have a very quick look at oil? That's the 4 tick. Let's look at the 2 tick oil. Look just there, see this just here, right? Straight away I look down here, see that just there, there's a higher high, there's a lower low, and see how we're bouncing off for 20. Now that is a no-brainer as well. Remember on that other time frame I showed you, it was actually a short trade. We were bouncing off for 200. That's why you would take this trade every day of the week. So on your high time frame, you take that, and that's is this one here, and that's another strategy again, but these kick butt as well. So not only have I got divergence, what I've actually got is a 2B on higher time frames. So traders, become a member. You'll learn all of these. There's just once again, visit my website, have a look at everything. Once again, divergence trading can be fantastic, but I really recommend you master trading with the trend and then move on to divergence trading. Thanks very much.